You talk about passive investing. It's kind of a hot button. 90% of flows go into passive strategies. Even pensions are in passive strategies. Talk about the perfect liquidity of passive investing.
The concept of passive, and now we're at a point where passive investments have eclipsed active for the first time in history. Mm-hmm. And my friend Mike Green, who's a friend of Real Vision, has done a lot of fantastic research on this.
Yes, he has.
And I've done some work, in essence, trying to replicate his assumptions using some toy models, and what was able to do that. But his theory at the end of the day is that at a certain point, if the market is dominated by passive actors, it not only amplifies volatility, which I completely agree with. If there is no other incremental seller against a buyer or buyer against a seller, each incremental a buy or sell will result in massive movement in the underlying. So
it's an amplifier.
It's an amplifier. Because if you look at active investors are a volatility dampener. Value investors will come into the market and they will buy when there is a big collapse in asset prices. So they will, in essence, put a floor underneath asset prices, and they'll sell when asset prices go too high. Well, you remove all the active investors, and that will amplify volatility. The other factor that comes into play a lot of the time is this idea that it actually reduces the alpha available to active participants.
Clearly, we're watching one asset manager after another, one hedge fund after another go away.
Because in essence, like passive is in its own right a systematic strategy. Mm-hmm. It has elements of, it is a basic systematic strategy. So it goes back to this soul of investing. There are two different competing thought processes, I think, that are at war with one another. The one thought process is that assets should have a value, that there should be a value, mm-hmm. And that market participants are fighting to determine what that value is. But there is, in theory, some intrinsic value to it.
Price discovery.
Price discovery. There's a second school, which I think is gaining strength right now, which is forget intrinsic value. All that matters, according to this school of thinking, is the price momentum of mm-hmm. the asset.
You can burn your MBA. You don't need it anymore.
That's right. So aspects of factor investing follow this principle. Whether it's momentum, quality, whether it's FANG, whether it's cat ownership of company management, whatever the factor is, as long as people believe in the factor mm-hmm. and
sure.
keep buying and keep providing, and as long as there continues to be liquidity, that creates value. I'm clearly in camp number one. I clearly believe that there's intrinsic value. I believe. Well,
if you go back 100 years, there is.
There is. And I would like to quote Harley Bassman, who once had a fantastic quote. He always says this, that pigs can fly if shot out of a large enough cannon. They always return to earth as bacon. He's so right on the money, with his usual wit. With a large enough amount of central bank stimulus mm-hmm. and enough ability to create debt,
right.
you can create this illusion as to momentum and these factors that. So I actually think passive investing is actually just a liquidity momentum trade.
I would agree with you. I mean, look, October 2018, it was not pretty. It acted as an amplifier, but on the downside. But we haven't seen a lot of that.